Namaste India. I'm CA Pranav Goyal, and today we're covering some interesting but tricky topics under the Income Tax Bill 2025. Ready to decode? Let's go clause by clause in the simplest possible way. First up, capital gains. What is not a transfer? Clause 70 of the new Income Tax Bill 2025 replaces the old Section 47 of the Income Tax Act 1961. Earlier, under Section 47 of the Income Tax Act, some transactions were not considered transfers for capital gains. For example, transfer of land by a Sikh industrial company when a AOP or BOI transferred assets during stock exchange restructuring, or even transfer of stock exchange membership rights. Now, Clause 70 of the new income tax bill removes these exemptions, which means such transactions may now be considered as transfers and could be taxable as capital gains. So, check your transactions carefully. What wasn't taxable earlier might now be. Second, gifts from family. Clause 92 replaces Section 56 of the old Income Tax Act. A big relief remains unchanged. If you get a gift from your parents, grandparents, children, or grandchildren, it's tax-free. What's new? The law now clearly says that it doesn't matter if the relative is from your father's side or mother's side, maternal grandfather or paternal grandmother, both are covered. A much needed clarification. No confusion. Only blessings are counted, not taxes. Third, clubbing of income. Technical spouse exemption. Clause 99 replaces the old Section 64 of the Income Tax Act. Let's say your spouse works with you in your business and earns salary. Will that income be clubbed with yours? Earlier law said if the spouse has technical or professional qualifications and their income is because of that expertise, then it won't be clubbed. Now, Clause 99 of the new bill says even if your spouse doesn't have formal qualifications but has knowledge, skill, or experience and earns money due to that, then that income won't be clubbed. This is a big boost for working spouses who have learned on the job and don't have degrees. Fourth, carry forward of losses in mergers. Clause 114 replaces old Section 72A and 72AA. Section 72A allowed companies to carry forward losses in case of mergers, but there was no limit. Now, under Clause 114 of the Income Tax Bill, if losses are transferred from a predecessor company to a successor company, they can be set off only for 8 assessment years. So now, there's a clear cap, 8 years. After that, the benefit ends. To wrap up, some non-transfer deals are now taxable under capital gains. Family gifts still safe with added clarity. Clubbing exemptions now includes practical experience, not just degrees. Losses from mergers, you've got 8 years max. Simple, sharp, and sorted. This is CA Pranav Goyal helping you understand taxes the easy way, because complicated clauses here need clear conversations. Jai Hind.